Welcome to the second in our three-part series of the Crypto Bootcamp. I'm Mark Simpson. I'm a partner in the London office of Baker McKenzie, where my practice focuses on fintech regulations. In the first session, we looked at the basics of crypto. In this session, we held a panel discussion on crypto regulations in the EU, Switzerland, the UK, and the US. This panel discussion was previously recorded earlier this year. I was very pleased to have been joined by a number of my colleagues from these jurisdictions: Iris Barsan, Jennifer Connors, Valerie Mirko, Julian Hui, Sam Kramer, Yves Mauchle, and Christopher Murrer. Let's jump into our second session.
Last week, we heard a very informative overview from a number of our colleagues on the crypto assets landscape in terms of what these assets are, how the technology underpinning them works, and the multiple purposes for which they're increasingly being used. In today's session, we're going to shift our focus to how the legal and regulatory framework is responding to these technological innovations. The rapid emergence of crypto assets poses a number of policy dilemmas to legislators and regulators. Foremost amongst these is how to ensure that the benefits of transacting in these assets, for example, speed of settlement, lower costs, and so on, can be offset against the risks to investors, consumer protection, financial crime, and financial stability. How do you protect for these real risks that exist, whilst at the same time ensuring that you create a regulatory environment that encourages continued innovation, and at the same time that the same safeguards apply to trading in these assets as when dealing with traditional asset classes? As we'll see during the session today, after a period of inactivity, we are finally seeing regulators and lawmakers start to catch up with the innovations that have been taking place. And the first tentative steps are being taken to produce bespoke legislation and rules in key jurisdictions. This is only going to be the first step on what could be quite a long journey. In the longer term, the implications of widespread adoption of crypto assets in payment systems and financial markets could be vast and would potentially trigger a need to revisit volume after volume of traditional law in order to account for adoption of this technology. We remain some way from that point, and we've got more than enough today to cover, focusing on short-term changes. So Kim, if you could please move to the next slide. During today's session, we're going to focus on the items I've set out here on the slide. So we're going to be doing a short recap on different players in the crypto ecosystem. We'll then talk about the regulatory framework in various jurisdictions and concerns that financial regulators have around crypto assets. We'll then look at some cross-border issues and have some Q&A from you as well. In terms of format, I'm going to start off by introducing these topics for a few minutes, giving some context before we move into a panel discussion. So, as you can see from this slide, we're going to have quite a lot to talk about, and we've included here a sample of press cuttings over the last few months. You can see the pace at which new laws are coming is really quite breakneck. So taking from the top there, you can see in the US, we've got the Biden administration reportedly looking at a new crypto regulatory framework, and we'll be hearing more from Sam and the US team later on during the session. Switzerland has recently brought in place new laws on tokenized securities. More generally, within the EU, we're going to have a new set of rules coming down the pipes in the next couple of years, a comprehensive framework for crypto assets regulation. Whilst here in the UK, we've been looking at our own proposals post-Brexit for a new framework around stablecoins and issuing our own central bank digital currency, which I think is going to be known as Britcoin, as our government's calling it. And similarly, we've got a number of other countries that are taking the opposite approach, really, by instead of trying to facilitate this framework, rather to put impediments in the way. So in Turkey, for example, other jurisdictions around the world, like Nigeria, we've seen recent moves to ban trading in crypto assets at all. So you can see quite a range of different regulatory approaches going on globally that we're going to be touching on during today's session. We're just going to spend a few minutes now talking about the different participants in the crypto asset ecosystem and the different roles that they play. So you can see here, going from left to right on the slide, you've got those who mine and create crypto assets. So like mining for gold, cryptocurrencies are often mined by individuals and companies using computers to process transactions and earn a crypto asset reward. And Sam and the team touched on this to some extent last week. This is a very resource-intensive process requiring heavy computing power to satisfy security conditions and ensure that all network participants agree blockchain is accurate in order for transactions to take place. For other token issuance, ICOs and platform generators, creators generate the relevant tokens for this activity. You've then got investors who are individuals or corporate entities that are involved in buying and trading crypto assets. You then have crypto exchanges. These include a whole range of businesses that exchange or arrange for the exchange of crypto assets basically online platforms in which you can exchange one kind of crypto asset for another based on market value of the given assets. Some wallets can also provide exchange services and allow purchase of standard coins. Alternative coins are then traded on centralized exchanges, which may not support the cash out element and specialize instead in the exchange between different types of less liquid cryptocurrencies for more common cryptocurrencies. Moving further to the right, you've then got custodians. So crypto asset custody solution providers provide storage and security services. They incorporate a combination of hot storage with a connection to the internet, cold storage, where they're disconnected from the internet, and vault storage, which is a combination of both of these things. You then see people like aggregators providing a sort of account information service, if you like, for crypto wallets, enabling customers to view all their transactions and having connectivity into various exchanges all in one place across their various different wallets and exchanges. You've then got traditional financial services providers, such as asset managers, investment advisors, and others who may advise on crypto assets, and banks also getting in on the action, both providing some of these services, such as custodian services increasingly, or even creating their own tokens. For example, certain banks have been involved in trying to create their own stable coins, and we'll come back to what those are more in a moment. And finally, you've got central banks, who, as I mentioned earlier, are increasingly looking at whether they can and how they should issue their own digital currencies. Move to the next slide, please, Kim. I mentioned before, there are a number of types of crypto assets. Regulators globally have started to try to put these into boxes, and the most common classifications are set out here on the slide. Generally speaking, regulation increasingly attaches as you move from the left-hand side of the slide over to the right-hand side of the slide. So starting on the left, utility tokens are those which grant holders access to a current or prospective product or service, but do not typically grant rights akin to investments in shares. For example, rights to use facilities or to purchase limited edition products ahead of the general public. You then have payment and exchange tokens. These tend to be a decentralized tool for buying and selling goods and services, with their core functionality designed as a means of exchange and can also be used for investment purposes. Token holders typically have no or very limited rights in these tokens. They're not issued or backed by any central authority, and Bitcoin and Ethereum would be an example of these. Classic cryptocurrencies or exchange tokens typically fall within this category. Moving to the center of the slide, you then have e-money tokens, which also have a core functionality of acceptance as payment, similar to exchange tokens, but with the key difference that they must represent monetary value and must have a central issuer, which means there must be a person who issues the token who is liable to redeem it on request, and it must be accepted as payment by a person other than the issuer. So where distributed ledger technology and crypto secured tokens are used to represent fiat funds, for example, sterling or euros or dollars, they may be e-money. On the right-hand side, you then have security tokens. This category refers to tokens that share characteristics that are more akin to traditional instruments like shares, debentures, or even units in a collective investment scheme. Typically, these instruments indicate an ownership position in an entity or a creditor relationship with an entity, or rights to participate in ownership or profit in an entity or enterprise. These may or may not be transferable, and you need to analyze each token on its face and look at the rights conferred on the token holder. The other category there is stablecoin. I've left this to the end because it's a slight hybrid of some of the other categories. These tokens are ones where there's an attempt being made to stabilize volatility of the asset and could fall within one or more categories on the taxonomy. For example, some of these will be fiat backed. So for example, by US dollars or sterling, or by a basket of currencies. The issuer of the coin can peg the value to the currency, for example, by guaranteeing its value, whilst holding a reserve of the underlying fiat currencies. But there are various different business models here. So other models can see the holder have an interest or right to the underlying custodied fiat currencies. Sometimes these stable coins can also be backed by a basket of crypto assets to spread risk and reduce volatility, or can be backed by another form of tangible or intangible asset with an economic value, such as a commodity. There are still further models that are not backed by any central reserve, but instead stabilized by an algorithm that may, for example, control supply of the tokens in order to influence price. And depending on how these coins are structured, they could fall within one of the other categories, for example, e-money or a security token. And finally, on the bottom of the slide there, you can see we've got hybrid tokens, which may have features of multiple types of the above. Some regulators have been clear that tokens can have different attributes at different points of time in their life cycle, and so can move from one category to another, or be in multiple categories. Great, so what we've done on this slide is to illustrate the point that was just being made, we've just set out here how the perimeter of regulations can apply to these tokens. So you have, first of all, AML regulations, which tend to apply across, or can apply at least, across all of these various categories. So the perimeter of anti-money laundering regulation tends to be the broadest of all the different types of regulation that applies to crypto assets. And again, this will vary by jurisdiction, of course, but this is just to give you an idea of the general theme. You also typically you would see exchange tokens like Bitcoin, for example, sitting outside the scope of traditional financial services regulations, at least in many jurisdictions, although that's starting to change. Although caught by AML rules, again, increasingly, you then have, moving over to the right, the e-money tokens, which are typically caught by payments regulation today. So they were regarded similarly to other forms of stored value product under sort of licensing requirements and the like, and stable coins, which again would typically be within e-money or payments regulation, or depending on how they're structured, could also attract securities regulations. And we've got another box on the slide there in orange, which talks about bespoke regimes for financial stability. So just to focus briefly on that, increasingly regulators and central banks are concerned about the systemic importance of stablecoins, particularly where you look at a large organization that's already got a very big number of users, for example, and which, if it were to start issuing a stablecoin, could get access to very large numbers of people very quickly. And those concerns are leading to regulators and central banks starting to look at whether they need to bring in additional gold-plated regulations to, properly supervise payment systems that might emerge in a systemically important stablecoin. The final point I'd mention here is that we haven't put on the slide anything to do with derivatives, because the slide focuses on the underlying tokens. But anytime you create derivatives on these assets, it's quite likely you may engage traditional financial services regulations as well. So it's worth bearing in mind. Can we move on to the next slide, please, Kim? So we won't go through these in detail, but just to briefly mention some of these activities which we're going to be talking about today that regulators are increasingly seeking to define as being regulated activities where you perform these in relation to tokens. And you can see there on the slide, many of these are similar to the concepts found in traditional concepts of securities and payments law. So issuing or destroying a token, providing custody services, acting as a broker or executing trades in tokens, providing advice. You've then got a bunch of other transactions that are more tailored to the crypto framework. So exchanging tokens for fiat currency, for example, acting to stabilize the value of a stable coin or to validate transactions. So again, a mixture here of traditional financial rules and some new bespoke rules that we're seeing coming into effect. Next slide, please, Kim. And in terms of the regulatory approaches we'll be discussing, I think we're going to see a number of these that are currently in play globally. So in some countries, there is still no crypto-specific regulation. In some, there is a minimal layer of crypto regulation, but mostly it's left to the scope of traditional rules to be interpreted. You've also then got a bunch of countries that is growing in number where there's an AML regime in place. And you've then got a further group where there is a new, relatively new crypto-specific regulatory regime being brought into place or already in place to deal with this on a bespoke basis. Great, so I think this is the point that we will commence the panel discussion, having had that overview. So I'm going to start for the next 20 minutes or so. We're going to talk about the regulatory framework for crypto assets, tokens, actors and services in a number of jurisdictions. And we're going to start with the EU. So I'm going to ask Iris, our colleague in Paris, to comment, Iris, if you can, please, on the EU Commission's proposed significant new regulatory framework for crypto assets under the Markets in Crypto Assets Regulation. Can you please explain to the group, how does the regime determine which tokens and actors are regulated?
Yeah, thank you, Mark. Gladly. So the EU Commission issued a draft regulatory proposal on 24th of September last year. And in this draft regulatory proposal, there are several aspects of, obviously. They first start by defining what a crypto asset is and defining different categories of crypto assets. So the crypto asset is classically defined as a digital representation of value or of rights that can be transferred or stored electronically on a DLT, on a blockchain most of the time. And then, surprisingly, the Commission doesn't go into the classic distinction we make between currency-like tokens, security-like tokens, utility-like tokens, and so on and so forth. What they do is they distinguish what we call, under the broad term of stable coins and utility tokens, and that is it. And this means this has a reason. First of all, this legislation, you have to understand, is subsidiary in nature. It means that if a token, the features of the token are such that it can be characterized as a security, securities regulations will apply. So this set of regulation will only apply if nothing else applies, which means that every single time you have to analyze any kind of token, you first have to determine what the characteristics are. And you already explained, Mark, that you can tokenize almost anything, and you can have hybrids that makes everything more complicated. And so if nothing applies, then this regulation would apply. And here the Commission focuses in particular on what you can call stable coins, but with some peculiar denominations, because they distinguish between asset reference tokens and e-money tokens. Asset reference tokens are pegged to some kind of basket, giving it some kind of stability. And e-money tokens are backed by one fiat currency, right? And so the Commission uses this definition then to regulate the issuance of tokens. So if you are an issuer of a regular crypto asset, of a regular token that is not an asset reference token or an e-money token, in that case, you have to draft a white paper, which is more or less similar to a prospectus. You have to notify your paper to the competent authority, but you can start your issuance before the competent authority. You don't need an authorization. So you draft your paper, you comply with the law, you notify it, you issue right away, and then the regulator has the possibility, if you did not comply with all the rules and regulations, to ask you to do better or to stop your issuance and so on and so forth. If, however, you are an asset reference token issuer or an e-money issuer, there you have to be authorized, right? So you need it becomes somehow a regulated activity. E-money tokens can only be issued by regulated banks and e-money providers, whereas asset reference tokens can be issued by other other issuers, but they need to be registered and authorized. And so this is the first distinction that is made. They also distinguish, once this distinction was made, they also will distinguish between significant asset reference tokens and e-money tokens and the other ones. And so if you issue anything that is, roughly speaking, a stable coin, so that's where financial stability is at stake, right? Because you peg these tokens to fiat currencies or baskets and so on and so forth. And so if you are significant in terms of volume of customer base and so on and so forth, then you will be supervised by the EBA. So there is a particular set of rules that will need to be complied with if ever you fall within the category of a significant asset reference token or e-money token. Whereas if you issue anything else that is not pegged to any kind of value, a utility token, a classic currency-like token like Bitcoin or Ether, or any other asset that is tokenized, as long as it is not a security, then you do not have to be authorized or registered. You can issue your tokens, but you need to provide your investors or potential investors with the relevant information, comply with a couple of rules, act honestly, provide clear and transparent information, and so on and so forth. So this is the part of the regulation concerning ICOs, initial coin offerings. Then you have a second leg to this regulation, which deals with the intermediaries, with the service providers. You have a list of service providers, you already showed that on one of the slides, that all start to become regulated. So almost any service you can provide on crypto assets will become a regulated activity. that is very similar to financial services providers. And there you have a list of service providers. The most important, perhaps the most sensitive, the poll was interesting to watch, the last one, is the custodian services. A custodian wallet provider is the one that holds either your private key, giving you access to your tokens, to your crypto assets, or holds the crypto assets on your behalf. And that is the reason why it's a very sensitive activity, because basically the guy can run off with your assets and you will never ever see them again, right? So this is these guys already have to be registered all over Europe, because it was part of the 5th AML directive, continue to be obviously registered, authorized, and so on and so forth. And then you have a more classical list of service providers we already have under MiFID II, like an operator of an exchange platform, exchange service providers, reception and transmission of orders, placing of crypto assets, advice, and so on and so forth. So these activities become, well, regulated in a way that is quite similar to MiFID II. And in exchange of this regulation, they benefit of a passport, meaning that once they are registered and licensed in one member state, they can circulate and provide use the freedom of services or establish in any other EU country. And finally, you also have rules on investor protection and market integrity, but I think we're going to talk about this a little later.
Thanks, Iris. So the EU's gone down quite a broad approach in terms of what it's seeking to regulate. Julian, could I turn to you next, please, and ask you to tell us a bit more about the proposals that are being brought in the UK in this area?
Yeah, thanks, Mark. So obviously there's the tension that a lot of regulators have faced in this regard has been trying to balance the need to encourage competition and innovation against the potential risks to customers. The UK has taken a very staged approach in actually looking through and conducting research and slowly analysing the relevant positions. In 2018, there was a joint report by the FCA, the Bank of England, and the government into crypto assets. And at that stage, they identified a number of risks relating to crypto assets, relating to financial crime risks, risk to market integrity, risk to consumers. But the view was that there wasn't actually enough information as yet to actually try and start regulating this area. There has, of course, been the implementation of 5MLD, which has come into effect, which has introduced regimes for money laundering, as I think we've already covered. But as yet, we haven't created specific regimes that would relate to any individual crypto assets unless they fit within an existing regulatory regime. There is one important caveat to that, and that is that the FCA has actually issued a ban on marketing or selling crypto derivatives and exchange traded notes to retail investors. And that was given the perceived risks of those sorts of products to investors. So that's where we're currently at in the UK. Now, moving forward, though, the UK has actually started to consult on expanding its regime to deal with specific crypto assets. So as Mark has noted, it's actually much more nuanced, I guess, than what the EU position is, because the UK is not looking to regulate all forms of crypto assets to begin with. So at first, what it's going to do is going to bring crypto asset promotions, all crypto asset promotions, under the existing FISMA regime. Which means in effect that you won't be able to actually advertise or promote those crypto assets unless you actually are an authorized person or can get it approved by an authorized person or an exemption applies. But then it will also bring stablecoin service providers within the scope of the new licensing rules. So the reason behind this was the crypto asset promotions. It was thought that this should apply to all crypto assets. The reason this is broader than the regulatory regime, which would only apply to stablecoins, is that FCA research had shown that only a small percentage of the population currently invest in crypto assets, and those investors generally understand the risks of investing. However, concern was raised that certain crypto asset activities, for example, involving stablecoins or activities which would expand the people who are investing in this, the investor community, could actually increase that risk. Therefore, the focus was we will ban the promotions, but we won't necessarily we'll regulate promotions, we won't necessarily regulate all forms of actual activity in that regard. Accordingly, the licensing regime is only looking to regulate various service providers, such as the exchange, custodian wallets, issuers, managers of stablecoins, the managers of stablecoin reserves, etc., who provide services in relation to those stablecoins, whereas the crypto asset promotion regime will apply to all fungible crypto assets, so it won't apply to NFTs. An exemption is obviously being created as well so that people who actually use crypto assets to try and make payments or to accept payments will not be caught by the stablecoin rules. So just very briefly, what are the key points of difference with MiCA? MiCA will apply to many more tokens than the UK position. MiCA includes the service of advising on crypto assets, whereas the UK position does not include advising. MiCA has much more detailed rules relating to listing and issuance of crypto assets, including those white paper rules that Iris was mentioning. And that probably reflects the broader range of tokens. And also quite importantly is MiCA has introduced a market abuse style offence, which the UK has not yet actually included, even though there was some recognition that new forms of market manipulation and insider trading and those sorts of market abuse type offences could be relevant going forward. So the state of play in the UK is effectively that crypto asset service providers need to be registered for AML purposes. Where a crypto asset falls within an existing regulatory regime, it will need to be subject to that existing regime. Crypto derivatives and ETNs have been banned from being sold to retail investors. In the future, all promotions relating to crypto assets will be subject to financial promotion rules, and various providers relating to stablecoins will need to be regulated. But that's where we're at in the UK market.
Thank you very much, Julian. Very helpful. And so to move on now to another European country, Switzerland. Yves, would you be able to explain to us, please, does the existing Swiss regulatory framework fundamentally differ from the EA in the UK, and how does FINMA, the Swiss regulator, analyse and assess tokens under Swiss regulation?
Sure, thanks, Mark. So to the first question, the answer is it's not really different. So EEA lawyers may get a rather quick grasp of the Swiss financial market regulation because it is very similar to the EU and EEA regulations. The reason for this is that Switzerland strives for regulatory equivalency with the EEA, so it can have access to those financial services markets. So over the last 10-15 years, Switzerland has substantially revised its financial market architecture. We call it the new Swiss financial market architecture, and the regulatory concepts substantially correspond to what we see in the EU. So you will see the Financial Services Act that largely takes up the conduct rules in MiFID II. You have the sustainability test, appropriateness test, information, organization, etc. All those things you already know from the EEA. And you have also prospectus rules that are very similar to the EU prospectus ordinance. You have the trading platform regulation that is pretty much the same, except in Switzerland we have a lot of regulation coming from the self-regulatory competencies of the exchanges. A substantial difference in Switzerland would be the payment regulation here. As opposed to the EEA, we have no comprehensive payments regulation, only AML, not prudential, unless the payment services provider would be systemically relevant. Now, you can see the general concepts are pretty much the same as in the EEA. FINMA uses a certain way to think about tokens within this existing regulatory framework. It has published guidance on ICOs in 2018. It has complemented this with stablecoin guidance in 2019. And very generally, it thinks about tokens in three categories. One, payment tokens. These have, as Mark has shown before, no intrinsic value. They just have a value because people use them as a currency, as a means of payment or storing value. If a token is issued for that purpose, it is generally subject to AML regulation, no prudential regulation, and you also have a lot of trading platforms engaging in cryptocurrency trading. This is not subject to prudential regulation. And then you have the utility token as the second category. This is the voucher for some kind of service. Here, FINMA, our regulator, also says This is generally not subject to regulation, but if it is for an unfinished service and the nature of buying a utility token is a very speculative activity that corresponds in essence to an investment contract, then it would treat this utility token for an unfinished service as a security. The third category is the asset token. Here we really have the security token. Those are the token that somehow represents an investment or a right. It also includes stablecoin, this category. You have, for instance, shares, bonds, other participation rights, but also property that is being tokenized and that falls under this category of an asset token. So this third category of asset tokens is generally treated as a security under Swiss law. Now, what does that mean? To trade in it, you may need a securities dealer license. To have a systemic trading in those asset tokens, you may need a stock exchange or similar trading facility license. If you offer them, you may need a prospectus. And if you deal in them, in any case, you will likely be subject to AML provisions. FINMA so thinks in these three categories: payment, utility, and asset token. And of course, if it is a mix of these three categories, it applies the regulation cumulatively. And in assessing which category this is, it applies a very economic approach rather than a formal legalistic approach. So it basically uses a derivative of the famous duck test to determine if something is a security. If it walks like a security, it talks like a security, and it quacks like a security, then it probably is a security, and we will treat it as a security. Lastly, will the Swiss regulatory regime be amended? Are there plans to make any changes? The Federal Council, our executive government, has looked at it in detail in 2018. They came to the conclusion that we already have a technology neutral and principle-based regulation. It didn't see the need for a substantial reform, but it has pushed three main topics through Parliament and amended various laws. One is the treatment of tokens in insolvency was clarified. It also clarified the treatment of other data in insolvency. Second, it amended civil law to allow the transfer of rights that are not certificated without the wetting signature. This was a big topic because under Swiss law, you could only transfer a right with a wet ink signature, which of course doesn't go along well with the blockchain. And finally, it introduced a new trading platform category on which people can directly participate in trading without being regulated themselves. So now these changes that will enter into force or have already entered into force this year partially, they conclude this mini revision of Swiss law. It was just an evolution, and I believe now we have a rather clear legal regime. Interest is high from the financial industry, from technology companies, but also from new players, because now I believe we really have a legal framework that works and that takes account of the specialties of blockchains.
Thanks, Yves. So we're going to move now across the Atlantic to the US, which I think is a jurisdiction that tends to scare people outside the US. I'm going to ask Jennifer and Valerie to comment, please, on how crypto is regulated at a US level.
Thanks very much, Mark. And yes, you're absolutely right that that the U.S. does often scare my colleagues across the pond and elsewhere. But I think that that's primarily due to the proliferation of regulatory bodies that we have here in the U.S. and sometimes the different analyses that they apply and some of the competing interests there. And Valerie's going to speak to that a little bit more. I was actually struck when Iris was speaking in connection with the proposed regulation because frankly, the rationale and the manner in which it's proposed to be applied to the asset class is actually very similar to the methodology that is used in the United States. So first and foremost, you look at the nature of the crypto asset and you analyze it to see which particular regime it will fall under. So one of the first and foremost considerations is whether or not, in fact, that asset may potentially be a security. And in terms of securities law, there is a very well-developed body of analyses there in terms of the regulation of the asset, and then therefore it would fall within the various different regimes, which would require a broker dealer to sell the asset or to offer the asset and an exchange in order to intermediate between two or more parties in exchanging an asset. Aside from the securities regime, though, crypto will also fall within other categories as well. It is first and foremost considered a commodity, although the commodities regulators do not typically regulate the spot market. But as Mark mentioned, derivatives on cryptos do raise other aspects. And then finally, to the extent that it is not caught within those regimes, it may very well be classified as cash or currency. And in that instance, we need to look to money transmission and money laundering regulations, anti-money laundering regulations that are applicable at the federal level, which requires registration, and then also at the state level. In the United States, we have not only federal legislation that we need to be mindful of, but also each individual state. And that applies with respect to all of the aforementioned regimes. We are now expecting that there could be additional guidance. We would not expect to see, similar to what Yves had mentioned, we would not expect to see a sort of fundamental revisiting of the guidance and some of the conclusions that have been reached thus far with regard to analyzing the assets and where they may fit in the various different frameworks. But we are expecting that we may see further guidance with our new SEC chair, who we expect to be active in this particular area. Valerie, I'm just going to ask you to kind of run through what we might expect from a future regulatory perspective and also the perspective of the states as opposed to the federal regulators in terms of their view of crypto assets.
Thank you, Jennifer, and good morning / good afternoon, everyone. I think this is going to be a pivotal year in the US in terms of cryptocurrency guidance, particularly because the newly appointed SEC chair who was approved for his role just 2 weeks ago has a very strong background in digital currencies, both policy and regulation. He's also been an academic in this area, and he's really immersed himself at a technology, policy, and economics level. That's a market change from the last 4 years of the SEC's leadership in this area. There's been a lot of interest by the SEC in cryptocurrencies, as well as all of the other federal and state regulatory bodies that Jennifer mentioned. But I think what's happened in recent years is that the legitimate aspects of the cryptocurrency industry have really been caught between multiple regulatory regimes who have all been trying to apply their existing analyses on a newer instrument. That's sort of been phase one. And as Jennifer said, there's a lot of similarities in terms of the analysis with, for example, what we heard from Yves, and that there is an existing regime. It's not crypto specific, but it can be applied. So I think we've moved past that first stage. What needs to happen at this point is really an understanding of the benefits and advantages of the cryptocurrency industry, and for regulators to stop stifling it. And where I think we'll see leadership is, as Jennifer said, from SEC Chair Gensler, because he has both the background in securities, commodities, industry, and also technology to bring leadership to this ongoing debate amongst regulators. And it is regulators, plural. In addition to the SEC, there are state securities regulators who have a strong interest in this, and particularly in the area of custody, have front-run the federal regulator. And that is something else that's having to be worked out both amongst regulators, but also amongst cryptocurrency firms and digital advisors who are looking to custody those assets. So that's one area of tension. Going beyond the securities regime, the other area of tension is at the level of federal and state banking and money transmission regulation. That is a very interlayered area of the law with different areas of focus in terms of what federal and state regulators are interested in. We see it particularly when it comes to money transmitter issues, which are closely adjacent to a lot of the issues that we're discussing today, particularly with regards to payment systems. Finally, looking ahead, like I said, I think this will be a pivotal year in terms of seeing at least one regulator with the expertise to push this forward. When I was on the regulatory side of the table, I worked with some of the senior level regulators who are on the staff at the SEC who have strong expertise in this, but came at it more from an enforcement and remediation perspective. They're very good, and I think their thinking has evolved, but having Chair Gensler as more of a balanced advocate for both the benefits of this industry, but also applying an overlay of investor protection, I think will be helpful in moving past the sort of current stalemate we've seen in the last few years amongst regulators.
We've got about 15 minutes left, and in the remaining time, we're going to move topic slightly now to talk about some of the substantive concerns that financial regulators have. And as we're running slightly behind schedule, I'd ask all of the panelists to keep their comments sort of relatively brief. But could we first pick up on the first substantive topic of fraud and anti-money laundering? And I'm going to ask Chris to talk about this. We know that regulators continue to be concerned about the risk of financial crime relating to the use of crypto, in particular anti-money laundering. Chris, can you talk a bit about how the Swiss authorities look at the issue of AML and how they apply the regime to crypto assets in Switzerland, please?
Sure, thanks, Mark. So as Yves mentioned, the Swiss financial markets regulator was quick in confirming that the AML regime applied to anyone issuing or managing token transfers of payment type tokens and perhaps stablecoins. But as a more unique feature in Switzerland, following FATF's release of AML standards for crypto, in 2019, this Swiss regulator confirmed application of the travel rule to payment token transactions. So the travel rule comes from the traditional payment world where financial intermediaries are required to exchange basic information about the sending and receiving parties in a transaction. And this information exchange creates a trail of information about who's sending and receiving money, helping with AML investigations. And the SWIFT system is a typical way that traditional institutions exchange this information about sending and receiving parties. But with crypto, Switzerland took an even stricter approach than what the current FATF standards are. So the existing FATF standards recommend the travel rule when the token transfer is occurring between wallets managed by two regulated entities. But they acknowledge that some crypto wallets are not managed by regulated entities, which are called self-hosted or unhosted wallets, meaning that the wallet is managed by someone personally and not a financial institution. The current FATF standards indicate that the travel rule is not expected if that token transfer involves a wallet that's self-hosted, but Switzerland's guidance doesn't allow for this carve out. So if a Swiss institution is hosting my crypto wallet and I give a transfer order to send crypto to my brother's wallet for his birthday, which he self-hosts, that Swiss institution is essentially required to KYC my brother to complete that transaction and fulfill the travel rule. Whereas this wouldn't necessarily be required under the current FATF standards. And how this works in the real world is still being figured out in Switzerland. As you could imagine, it sounds like a very labor-intensive practice and would pose a significant challenge to this industry developing in the way that it was originally envisioned. But that being said, based on recent proposed updates in the US and by FATF, I wouldn't be surprised if more countries follow suit with Switzerland's stricter approach on this. And I will defer back to Mark to keep my comments brief.
Thanks, Chris. So the travel rule, I think, is what we in the EU is called the wire transfer regulation. And in my experience is sort of not always particularly well complied with. So I don't know whether that reflects the position in Switzerland, Chris, but another sort of complication there around wire transfer and travel rules for people to deal with. Thank you for that. So just changing topics slightly to payment services concerns. So as we've been hearing, one of the key concerns I think that regulators have is around the potential mass adoption of cryptocurrencies for use in traditional payment systems. And we've seen a number of high-profile stories in the press over the last month or two around, large merchants like Uber and people thinking they might start to accept cryptocurrencies as a means of payment. Julian, if I can come to you on this question, it's clear that regulators are concerned about this. Can you sort of give us a sense of what these risks are and how regulators are addressing them? And maybe could you also just comment as part of that briefly on the final point on the slide there around central bank digital currencies and how proposals around those fit into this broader regulatory theme, please?
Yeah, so before this session, Kim and I were talking, and I think the way that Kim expressed this was quite good, which is, we've had concerns around shadow banking for quite a while, but this crypto world adds the issue of, I guess, shadow payments. And that's those payments that fall outside of the usual regulatory scrutiny and protections, and which are not generally well seen by the rest of society. Now, the first and foremost risk, as Chris has covered, is obviously AML, and that's been focused on for quite a long time. The UK National Risk Assessment, for example, recently upgraded the risks related to crypto assets, and so I think that's quite a well-known risk. But concern has now started to turn away from just the AML and financial crime element and more into also protections for users of crypto assets and ensuring that they retain similar protections to those that are received by current users of payments or electronic money services. So some of the risks that have been identified are risks of, I guess, supposedly stable assets going through periods of volatility, which can cause loss to people who had really only intended to use these assets as actually a means of payment. The risk of the crypto assets system itself being shut down, for example, through either an outage at one of the service providers, like an exchange or a wallet provider, or an actual outage at the system itself. There's risks of loss resulting from hacking or other technological weaknesses, risks relating to hidden or excessive fees, customer data being misused, risk to competition if a certain stablecoin becomes, I guess, dominant, and risks obviously relating to the infrastructure for crypto asset systems which function as payment systems. So there are a lot of risks that regulators are starting to sort of take into account when considering what how crypto assets might be used as a payment means going forwards. So in effect, we're now looking to move to a position where crypto assets which form functions similar to cash will be regulated in a manner which is similar to cash. And so that, for example, is why a lot of these regulators are really focusing on stablecoin and stablecoin initiatives. And that has formed, I guess, the initial focus of both a lot of national competent authorities, but also at an international level with groups like the FSB and the Bank of International Settlements, the BIS, looking at global stablecoin initiatives. And a lot of that was driven off Facebook's LibraCoin and what now called Diem. So finally, I guess, the last, I guess, real issue in terms from a payments perspective is national governments becoming increasingly aware of the threat that these shadow payments will have on their ability to control monetary policy. And they're looking to limit the issuance of new money by, I guess, non-central authorities. To this end, these national central banks have increasingly been looking into central bank digital currencies, which is the CBDCs, which will adopt many of the efficiencies of crypto assets for the backing of the central government. The ECB has recently announced it's moving forward with its considerations of CBDC, and the UK has created a task force to look further into a BOE-issued CBDC. This could open up a wealth of new possibilities, including potential for new service providers to interface between the central bank and core ledger and users. It'll be interesting to see what this approach will actually do with stablecoin creations, whether it will dampen interest by providing a sort of more widely accepted alternative, or whether it will increase interest by normalizing these sorts of arrangements. But yeah, so I think the payment sphere is obviously a big one that people are recognizing the potential of these crypto assets.
Thanks, Julian. So maybe just sticking with that theme around stable coins, and to get a US perspective, Sam, I was wondering whether you could tell us a bit, please, about how regulators in the US are framing the discussion around stablecoin regulation, including how they would address any regulatory concerns around that.
Thanks, Mark. And we've touched on stablecoins. A number of us have already, and you, Mark, in particular. I think at the outset talked about kind of different approaches to stablecoins. There's the well, what are they to begin with? And what most people know about cryptocurrencies is there's a significant amount of volatility in the value of cryptocurrencies. And in an attempt to bring some stability to value, there's this notion of stablecoins. And stablecoins have some sort of controls on them in order to try and keep the value from being as volatile as non-controlled cryptocurrencies are. And that's done principally in two different ways: algorithmic, where the algorithm controls, expands or contracts the supply of the coins, and then collateral-backed cryptocurrencies, which could be backed by fiat currencies, dollar, sterling, euro, etc. Could be backed by commodities, gold, for example. And the US used to back its currency with gold, or other types of assets, whether they be bonds, other digital assets, including groups of cryptocurrencies. So those all can be stable coins. And that points to the fact that our regulators in the US have not adopted a uniform definition of what a stable coin is. As Jennifer and Valerie had previously discussed in terms of the regulatory landscape for cryptocurrencies in the United States, we have a lot of regulators, and we have a lot of regulators that like to stick their fingers into the cryptocurrency pie. We know, for example, that the SEC, who's been pretty active in dealing with cryptocurrencies as securities, has told us that the Howey test for investment contracts still applies in the case of cryptocurrencies. But at least in some public remarks that have been made, we've heard from the SEC that perhaps one of the prongs of that test, which is the expectation of profits based on the efforts of others, may not always apply, at least to collateral-backed stable coins. So there's some open question as to how stable coins will be approached by the SEC, depending on how it's characterized. We know that money service business, MSB regulation, money transmitter regulation will continue to apply to issuers of stable coins. But there's been some movement with respect to the Office of the Comptroller of the Currency, which is one of the regulators of our national banks, particularly some recent interpretive guidance that they've issued in January of this year, indicating that it is within the scope of safe and sound banking practices for banks to facilitate customer transactions through the use, issuance, and exchange of stablecoins. And that's a pretty big deal. And follows a particular history of the OCC. Back in July of last year, they first told national banks that they could custody cryptocurrency. And then in September, released another interpretive letter, very interestingly, going into some detail around holding stablecoin issuers' reserves. And there it was very limited to, it had to be associated with a hosted wallet, had to be backed by a single fiat currency. It was limited to 1-to-1 ratios of the stablecoin to the fiat backing. And the bank would have to verify that the reserves were greater than or equal to the issued stable coins on a daily basis. With respect to the new guidance that they've issued regarding use, issuance, and exchange of stable coins, they did not refer back to this prior guidance to indicate that the only stable coins they were talking about were the types that they could deal with when they were handling reserves. So it remains a little bit unclear as to how stable coins are going to be regulated by the OCC and other regulators in the US, again, depending on how they're structured. Is it one-to-one fiat that's backing it? Is it a basket of commodities like we've seen with respect to Diem, the Facebook initiative? But most likely it's not going to include the algorithmic stable coins. Those, pretty much have gone by the wayside. We did see one major one, Basis, that was released in 2017, shut itself down when it determined that it was most likely to be seen as a security by the SEC. So that's a couple minutes on how stable coins are viewed in the US.
Thanks, Sam. Very interesting. And I think reflective of what we're seeing globally, I think that regulators and central banks are still learning a bit about how these work and probably still trying to figure out in their own minds exactly how they should, to what types of coins their regulations should attach and what compliance obligations they should put on the participants in different types of arrangements. So very interesting to get a US perspective on that. Now I've got one more question. So Iris, just to come to you finally then to close out the session on the final topic here. You talked a bit in your statement earlier around MyCar, around balancing innovation with consumer protection. Would you be able to just give us a bit more perspective around how regulators are attempting to do that, please?
Yes, gladly. Well, it's a true balancing act. It's a very delicate balancing act to regulate this ecosystem, because we're talking about, firstly, a very tech-savvy ecosystem that is anything but mature yet. I mean, we've still not explored the whole potential of blockchains. It's not just one blockchain, but it's blockchains. We're talking about second, third, fourth generation blockchains. And a lot of these projects haven't gotten to their peak yet, right? So we're still exploring the potential of blockchains and cryptocurrencies on the one hand. Secondly, it's a startup ecosystem. And in any startup ecosystem, 95% of all projects fail. Now, if you combine this with this very tech-savvy ecosystem, you get the picture that it is, well, something where you are still exploring a lot of stuff, but you don't know when you will hit the end line and where this will get you. And on the other hand, you have the investors, right? I mean, no project works without the money that is actually fueling it. And so all these initiatives need funding. And a way to obtain this funding was to start to kind of circumvent the IPOs by inventing ICOs, right? Initial coin offerings, and telling people, look, guys, you can buy some token that will give you some future right into something. You don't even know if it's ever going to exist or what is going to happen with the money you give me. But it's a promise I make you. I'm selling a piece of hope, of future hope, right? And so you have on the other end, these people who see that Bitcoin increases in value every single day and think, why shouldn't I try it? But you face people who actually don't have a lot of financial knowledge and even less tech knowledge. And so they're putting their money into these projects without actually knowing what they're doing. And there have been, as in any startup ecosystem, a lot of scams. A lot of people lost their money. It is a highly speculative ecosystem. I mean, in 2018, Bitcoin hit 20,000 euros before falling back to 6,000, right? So if you put your money into your savings into that, you lost quite a lot of money. On the other hand, a couple of people who invested at the right moment earned a lot of money. So it's very speculative. It's a dangerous ecosystem for the consumer investor or the retail investor, right? Who doesn't know, has a lot of knowledge about anything he's putting his money into. And therefore, it's the task of the regulator to protect these people. But protecting these people can hamper, obviously, innovation. And so it's very delicate to find the middle ground. And if we put aside the topic on stablecoins and digital bank, central bank digital currencies, which is a specific topic that actually overshadows the more general blockchain innovation and protection topic, then you don't have the right recipe yet. Because if you start regulating too early, then you might hamper innovation. France has made this experience. We've been one of the first countries trying to regulate this ecosystem by a very peculiar set of rules. It didn't work out as intended at all, right? And if you have too harsh rules, too MiFID-inspired rules for an ecosystem that is actually built of startups, you might also asphyxiate any kind of innovation. So it's not an easy topic. It's not easy to find the middle ground between protecting the people that need protection and allowing these people to test and see where this innovation gets them to. And in my eyes, the UK approach seems interesting because you actually seem to tackle the transparency side, investor protection side, without trying to regulate everything behind it, right? And so I would be very curious to see where that gets you.
Yeah, no, I agree with that, Iris. I think the UK is going to do it in stages, right? And probably make an intervention and see if it works. And if it works, they won't necessarily do any more. And if it doesn't work, then maybe they'll think again. But yes, I agree. It's an area where, you know, I'm not sure that the governments have necessarily figured out yet exactly what the right balance is. And I get the sense they are sort of in response mode, trying to, you know, address existing harms that are there, but they can't necessarily predict forward how this might pan out, right, in terms of greater use of this technology as we go into the future. But thank you, those insights are very helpful.
Thank you for attending. We encourage you to join us for the next session, where our panel of experts will discuss crypto regulation in APAC jurisdictions, covering Australia, Hong Kong, Japan, Singapore, and Thailand. To find out about our offering, please get in touch with me or your usual Baker McKenzie contact. We provide updates on crypto asset regulations on a continual basis, so please visit our website and blogs to keep up to date on crypto news.